Welcome to another video of Financial Indicators, video number 8 by Fahad M. Gohar. Today's video will be talking about the important subject, which is the inflation rate. This is a very important financial indicators. The inflation rate actually is a key economic indicators. What it does, it measures the percentage changes in the price level of a basket of goods and services, of course over a specific period of time, usually 1 year. It reflects how much the price are rising or falling in that matter in an economy, which impact of course the purchasing power of the end user, customer, and also investment decision for expansion or contraction, and in general the overall economic health. So now let's see exactly how inflation rate is calculated. It's a formula, very straightforward. We can use inflation rate equal what? The CPI, which stands for Consumer Price Index, for this current year, minus the CPI for the previous year. Then you divide that by the previous year CPI and you multiply by 100 because you want to get a percentage. It's that simple, so it's not that difficult to calculate it. Now let's see some facts that are very important. One of these facts, for example, is that the central bank usually, like the Federal Reserve, they like to have the inflation rate target often around 2% or 200 BPS. If you ask what PBS stands for, in finance, it's the basic points are typically expressed with what? With abbreviation, they call it PB or PBS or BIPS. One, of course, basis point is equal to what? 100 of 1% or 0.01. This chart here or spreadsheet will give you an idea, like the basis point. If it is 1, what's the percentage? What's the number? If I say it's 200 points, you just say 100 points is 1%, 200 points 2%, etc., etc., just like that. It's a straightforward. And then there is something else also. This is just some information for you to digest. There is something we call real interest rate, which will equal, of course, the nominal interest rate minus the inflation rate. This is a subject you have to have some knowledge about. Now what's gonna happen, there are tools of investment for investors. One of them, we call them diversification. What does it mean, diversification? Investors usually might diversify their portfolio by shifting what? To assets that perform well during inflation period. Which one? Of course, commodity. Just like the real estate, prices will go very high for real estate when there is an inflation, and or any inflation protected security. So you will see the investors shifting to that sector. Also, another tool investors will use, they call it hedging strategy. What does it mean, hedging strategy? Investors may use specific financial instrument, like for example the option, everybody knows, or the future, to hedge against what? Inflation risk. So what they do, they hedge against it, like TIPS in the USA, where the principal and interest payment adjust with inflation, which preserve the purchasing power of that hedging or that tool that's used by the investor. Now let's see what exactly the inflation category, because it's very important to know when we hear those names, what does it mean? When we say this inflation, What does it mean? Disinflation mean a reduction in the rate of inflation. Reduction. We have inflation, now we have disinflation. Prices are rising more slowly than rising very quickly. It's often seen as a sign that inflationary pressure are easing, which can stabilize the market. And then we have deflation. Deflation is a decrease in the general price level. While this method might sound beneficial, deflation can also be harmful, as it often leads to reduction, in consumer spending. Of course, that will lower the profit for business and will end up having higher employment. The worst of all, stagflation. Stagflation, is a situation where high inflation is combined with stagnant economic growth and high unemployment. Of course, this is particularly challenging for policymakers, because the usual tool to combat inflation, like when you have inflation, what you do to combat it, you raise interest rate. But here, if you raise interest rate, the matter will worsen even, for the unemployment. So it's very risky situation. So now let's see how the inflation rate level are. Okay, we have 4 levels we will address here. Okay, first level will be between 1 and 3%, and then between 3 to 5%, and then between or above 5%, or the worst, it's above 50% per month. Okay, so the first one we start with, it's what we call it low inflation. It's generally seen as a healthy for the economy. That's between 1 to 3%. Here we can say it's okay, no problem. Then we have what we call it moderate inflation. This might signal a growing demand in the economy. Why? Because now people want, let's say, like crazy, want to buy houses. Suddenly the houses prices goes up, or they buy a lot of cars and then the car suddenly goes up. This is a signal that the prices are heading up. So now here the politician and policymakers will start taking note and making sure, let's curb that very quickly. Of course, the first tool we know, raise the interest rate, dry up the market from funds. You can drag back the economy or the inflation backward, so it's not going to get worse. That's one of the tools, of course. There are many other tools. And then we have anything above 5%, it's high inflation. This could indicate an overheating economy, which will lead to a potential economic issue, of course. And then comes the worst, the nightmare, which is the hyperinflation. That's an extreme inflation over 50% per month. It leads to a complete loss of confidence in the currency. Now let's see those levels, how they affect some elements. Let's see that in this area here. First of all, when we have a moderate inflation, what's going to happen? The moderate inflation, like I said, prices for houses goes up. That will boost, of course, a company, profits, because the companies will invest in real estate, and the stock prices will go high for those companies, of course. Okay, but now when we have a high inflation, what's going to happen? What's the first thing will be, affected? Of course, commodity like company oil, and gas will benefit from that high prices when we have a high inflation. Okay, but now let's see what's gonna go down. Who's gonna be affected when we have a high inflation? When we have inflation, we have an increased business cost. Raw material will become more expensive, and the labor and the energy, which will hurt, of course, profit, and that will lower the stocks for those companies. So it's not a good sign. And then others also will be, affected negatively, will be, the tech sector, the tech company with fixed cost will suffer, of course, in operational cost, because everything is going too high, you know, and eventually the stocks and bond will their yield will erode, you know. So that's the effect of the high inflation will be reflecting on the those sectors or those elements. Here are some charts for you, you know, to benefit from, and see CPI, which is Consumer Price Index, and inflation rate over time, of course. Here the inflation rate, you know, over time, years by year. As inflation rate increases, you know, you can see the CPI, you know, try to, you know, CPI goes up, you know, as the inflation increases, you know, and how that affected. And also here, stock market performance versus, you know, inflation rate, almost similar like the CPI, you know, just for your own information. And then the bond, of course, because remember, bond always work the opposite way. When the economy it's bad, you know, companies, government usually will issue bond with a higher yield, you know, and so those bonds will become a better investment to protect, you know, the riskier of the market, you know. That's so where people, you know, investors will start investing in those bonds, you know. So the bond become very attractive. Of course, the newer bond, not the older bond. The older bond will have still a lower yield, but the newer bond will have a higher yield. So I hope this was beneficial information in a short period of time. Good luck, and I'll see you in the next video.